Gold should be rising amidst war, inflation, and general uncertainty, but right now it's actually falling. Why is this happening? My name is Dmitry Kotegov, and I'm an investment strategist at Abeta Capital. On this channel, we quickly break down the latest news and key trends that impact our investment portfolios. Subscribe to this channel and hit the bell icon so you don't miss any of our latest videos. And right now, we're going to analyze what's really going on with gold prices. Is this a temporary technical correction or a break in the long-term bullish trend? Historically, gold should protect against at least three factors: rising geopolitical risks, rising inflation, and central bank errors. By central bank errors, I mean a situation where a country's national debt grows uncontrollably, revenues fall, and investors have reasonable questions about the stability of its national currency. In this case, I'm referring to the United States dollar. Today, all three factors are present, and they should all be supporting an increase in the price of gold. Specifically, we're seeing an incredible surge in geopolitical tension due to the war in the Middle East. Rising commodity prices lead to higher inflation expectations, and for a country actively involved in military actions, namely the United States, the national debt continues to grow as war must be financed. According to classic logic, all of this should have led to an increase in gold prices. But what do we see in practice? In practice, gold has fallen significantly. From peak levels of $5,600 per troy ounce, gold corrected to $4,100 per troy ounce. That is, the drop was more than 25%. Let's take a look at why this is happening. Is it time to panic, or should you be actively buying gold right here and now? There are several key factors that explain the correction in gold that we've been observing lately. The first factor is interest rates. Before the conflict in Iran, the market was pricing in 2.25% interest rate cuts by the Fed in 2026. But since the current situation began, commodity prices have risen significantly, inflation expectations have increased accordingly, and this has influenced participants' views on future Fed monetary policy. Specifically, that the Fed will stop lowering interest rates. That's why today we see zero future interest rate cuts from the regulator priced into the market. Naturally, this has been reflected in yields. Yields in the bond market have risen, and basic economic theory states that when yields rise, the prices of metals, including gold, should fall. This is exactly what we are seeing today. Looking ahead, we believe that investor expectations are overly pessimistic, but we'll discuss this in more detail later. The second factor is more of a technical one. After gold began its correction, it quite rapidly broke through some important technical levels. For example, the 50-day moving average. And for many algorithmic and systematic funds that simply follow set rules, these are critical levels that trigger a sell signal. This is exactly what we saw when gold fell. The second important, yet also technical aspect, during gold's growth period, a large volume of longs was formed, including by speculators or so-called weak hands, who start actively getting rid of the asset if its price dynamics begin to reverse. This is exactly what we observed as well. Speculators, seeing that they'd managed to make significant money before, but now gold is going against them, started actively dumping the metal. Some started adding shorts. Therefore, the excessive positioning we saw earlier began to deflate quickly, like a bubble. The third factor is liquidity. When events of this kind occur in the market, meaning a surge in geopolitical tension, assets move in different directions, and many investors start facing margin calls. This is a situation where they need to get liquidity from anywhere to cover the margin call so they aren't forcibly liquidated by the exchange or broker. Naturally, it's easiest to sell what has grown the most before and is currently in the black, and gold is traditionally an excellent source for funding margin calls. So we also saw gold sales from this category of investors. Central banks can be put in roughly the same category, as we know that for several years many central banks actively bought gold for their reserves. But now the situation has changed. For many, the sharp rise in commodity costs is a problem because many countries are net importers of raw materials. They need to fund commodity purchases at higher prices somehow. They need to support the national currency's exchange rate somehow. To do this, they need to extract liquidity and sell something. And what's the easiest thing to sell? Again, gold. That's why we also saw technical sellers in the market, forced sellers who simply needed the money. And the fourth factor is the rise of the US dollar. Traditionally, commodities are traded in dollars, so the rise of the American currency against others leads to the automatic devaluation of many commodities, including gold. To sum up, the correction in gold that we've seen is explained by two key reasons. First, technical factors, and second, a reassessment of market participants' expectations regarding future interest rates in the US. In our opinion, this isn't a break in the long-term uptrend, but a temporary technical correction and a rather harsh market reset. At the same time, the structural reasons for medium and long-term gold growth haven't gone anywhere. We've talked about why gold has corrected significantly. Now let's discuss what we expect from gold next. Actually, we see two key scenarios, and looking ahead, each of these scenarios will, in our opinion, have a favorable impact on gold prices in the medium and long term. The first scenario is de-escalation. De-escalation will lead to a drop in commodity costs and consequently to a fall in inflation expectations. A fall in inflation expectations will lead to a drop in yields in the bond market and accordingly to a decline in the US dollar. All these factors will have a favorable effect on the price of gold. At these moments, central banks that previously sold gold to finance their domestic economic activities will likely return to buying the metal again because the structural problems in the global economy haven't gone anywhere. We also know firsthand that many investors have always wanted to build a significant position in gold in their portfolios, but the metal's relentless rise meant they kept putting off that moment in time. But current gold prices definitely look much more attractive than what we were seeing just a couple of months ago. Therefore, this category of investors, among others, will begin carefully purchasing gold. And we've already seen a brief version of what happens to the metal in the event of de-escalation when Donald Trump announced that he was actively negotiating with Iran to end the conflict on certain terms. We saw the reaction. Gold began to rise just as actively as the stock market. So basically, we already understand how gold will react to a conflict termination scenario by rising. Let's discuss the second scenario, namely an increase in geopolitical tension and not so much de-escalation, but a further escalation of the current conflict. We've already seen the initial reaction, a rise in inflation expectations, which, among other things, puts pressure on gold. But in reality, historically, this is followed by a shift in expectations regarding the future trajectory of economic growth, because high inflation and high commodity costs definitely have a negative impact on GDP growth rates and consequently on the increasing likelihood of a recession. And historically, that is exactly what has happened. Accordingly, the initial shock reaction to rising inflation passes. After that, investors start thinking, what comes next? And next, with a high degree of probability, the global economy could slide into a recession. Consequently, regulators will enter the market, specifically the US Federal Reserve, and will likely think not about raising the rate and further killing the economy, but about the need to stimulate the economy and lower the rates. This will lead to a drop in yields in the bond market, a decline in the US dollar, and a rise in gold. Because gold is traditionally an excellent hedge in cases of recession. And besides, if we're talking about an escalation scenario, at some point investors will remember that gold is actually an excellent hedge against geopolitical tension. Therefore, even in this scenario, gold is likely to rise in the medium to long term. On our Facebook and LinkedIn pages, we regularly publish detailed analytical reviews as well as current investment ideas. This is a more dynamic format of analysis that can't be packaged into our weekly YouTube videos. So if you're interested in this format, follow the link in the video description and subscribe. Now let's talk about what we did tactically. The gold candle on March 23rd was very telling for us, when gold corrected by almost 10% within the day. For us, these kinds of candles are a very important sign that someone in the market hit their margin calls, meaning there were forced sellers in the market who were selling at any price. Well, traditionally, this is an excellent moment to strengthen a position in an asset. We didn't manage to buy at 4,100, but at the 4,200 to 4,250 level, we actively added gold to portfolios because our medium and long-term outlook on gold, as we said earlier, remains extremely bullish. The immediate target we see is $5,000 per troy ounce. After that, we'll likely head towards $6,000. So, in our view, you should actively take advantage of these dips to buy assets that you find interesting and attractive, and that fit within your investment portfolio. But generally, for any individual investor, it's not that important whether gold costs $5,000 or $6,000. The first step is to develop an investment strategy for each specific investor, considering their risk profile, goals, and constraints to clearly understand which asset classes should be in the portfolio and what the maximum and minimum allocations for each asset should be. If you'd like, we can certainly help you navigate your specific situation and build a portfolio that fully aligns with your risk profile, your goals and objectives, and your constraints. To do this, sign up for a consultation with our analyst, and we'll work with you in a very productive, fruitful, and efficient manner.